You have $500, and the app glow feels bigger than the money. This is the story of every level of the retail investor, from the first deposit to the rare point where your results stop looking random. The numbers change, then your behavior changes with them. You open the brokerage and stare at a blank dashboard like it means you have entered a new class of person. Level 1 begins with a transfer that feels brave because your cash has always had another job. Rent is real. Groceries are louder than compounding. At this level, the trap is motion. You think buying something quickly will prove you belong here, so you grab a stock you half understand and watch every tick like your identity is on the line. Most people confuse access with readiness and lose confidence before they build any skill. So you add another few hundred. Maybe you reach $1,000, maybe $2,000. Level 1 still has you. Every green day feels like talent. Every red day feels personal. The bridge forward is simple to describe and hard to live. You stop treating the market like a slot machine with better branding. Now you have around 3,000 to 10,000 invested. This is level 2, the education stage that pretends to be the hustle stage. Your nights fill with charts, earnings clips, message boards, and hot takes from people who always sound certain after the move already happened. The trap here is borrowed conviction. You buy stories because they arrive polished, and you sell because your own reasons were never sturdy enough to survive a down week. Most people are not losing to the market yet. They are losing to other people's certainty sitting inside their own account. You start building a watch list. You learn what a balance sheet says, what it hides, and why valuation matters after the excitement fades. Progress feels slower now. Good. The bridge to the next level is that your decisions begin to sound quieter inside your head. Around $10,000 to $25,000, you hit level 3. The account finally feels substantial enough to imagine a future from it. A good week can pay a bill. A bad month can erase one. You are no longer dabbling. You are exposed enough to discover your real tolerance for risk. This is where many retail investors become collection agents for their own bad ideas. They average down because admitting a mistake feels expensive. They add positions until the portfolio turns into a junk drawer. The trap is attachment. You stop managing capital and start defending past versions of yourself. The ones who make it through this level narrow their field. Fewer positions, clear reasons. Position size is small enough that one idea cannot stain the whole account. You begin keeping records, not for content, not for performance theater, but so your future decisions are less emotional than your last ones. Then the market gives you a run. Maybe your account pushes toward 30,000, 40,000, even 50,000. Level 4 starts with confidence and usually arrives wearing disguise. You think the breakthrough is money. What you actually received was proof that a rising market can make your flaws look intelligent for a while. The trap here is overfitting your ego to a lucky stretch. You increase size too fast. You drift into options you cannot price well. You stop asking what would disprove your thesis. Most people do their most reckless buying right after the first period that makes them feel qualified. This is a painful level because the lesson usually comes as a drawdown. Fast, memorable. You watch gains evaporate and realize you are measuring progress in screenshots, not process. The bridge is humility with teeth. You build rules that can survive excitement, boredom, and the need to get even. By the time your portfolio lives between 50,000 and 100,000, level 5 begins. The account has weight now. Losing 5% hurts in actual dollar terms. A casual mistake costs more than your old monthly savings. You feel the market in your stomach because the numbers finally matter outside the app. Here, the trap is confusion between activity and edge. You know more than a beginner, so you expect that knowledge to produce constant action. It rarely does. The stronger investors at this stage spend more time filtering than trading. They let cash sit. They wait without feeling useless. You also notice taxes, fees, slippage, and concentration in a way you never did before. Boring details start shaping returns. This level rewards structure. Asset allocation becomes a real decision. Your process grows from ideas into a system, and the system starts protecting you from your moods. Crossing into $100,000 to $250,000 changes the temperature. Level 6 is where ownership feels adult. Dividends look tangible. Market drops can wipe out the equivalent of a vacation or a used car in a week. You stop fantasizing about turning every trade into a win and start caring about durability. The trap now is subtle. You become conservative in the wrong places and reckless in the hidden ones. You diversify endlessly, then panic all at once, or you cling to one big winner until valuation stops mattering. Most people at this stage are fighting concentration risk with stories instead of math. The bridge forward is emotional range. You learn to sit through ordinary volatility without touching anything, then act decisively when your process actually calls for action. That takes reps. It also takes a life outside the market, because a portfolio should fund your life, not replace it. When your invested assets move toward $250,000, $500,000, and beyond, level 7 begins. The numbers are large enough that compounding becomes visible in annual chunks. A solid year can add more than you once earned from work. The market starts speaking in 5 figures, then 6. This level looks luxurious from below, but the trap is identity inflation. You start believing your portfolio is evidence that your judgment is superior everywhere. That belief leaks. It shows up in oversized bets, private deals you cannot evaluate, and the quiet assumption that the future owes you your recent pace. The investors who keep climbing here become strangely plain. They know their circle. They protect downside first. They compare themselves to a benchmark with honesty, because beating the market means something specific now. It is no longer a feeling. It is repeated risk-adjusted discipline over enough time that luck gets tired. And if you reach the point where your portfolio can genuinely outperform over years, the view is quieter than people expect. You do less proving. You need fewer opinions. You understand the whole climb was really a long argument with impatience, ego, and fear. Tell me the level you crossed last, and what it cost.